Imagine two companies. Both companies have stocks trading in the market, but one company could be a great investment, while the other could be losing money every year. So, how do investors tell the difference? The answer is fundamental analysis. Fundamental analysis is the process of evaluating a company to determine its real value. Instead of looking only at stock price movements, we look at the business itself. We analyze the company's revenue, its profits, its debt, its growth, and its future potential. Because when you buy a stock, you are not just buying a ticker symbol, you are buying a piece of a real business. So let's get started. Revenue. One of the first things investors look at is a company's revenue. Revenue is simply the total amount of money a company generates from selling its products or services. It is often the starting point for understanding the size of a company's business. In general, investors like to see revenue growing year after year, because growing revenue usually means the company is selling more products or attracting more customers. However, revenue alone is not enough. A company can generate a lot of revenue and still lose money. That's why, after looking at revenue, investors also need to examine profits. But as a general rule, a company with consistently growing revenue often has a better chance of growing in the future. Net income profit. After understanding revenue, let's move to one of the most important numbers in fundamental analysis, net income. Net income is the money a company keeps after paying all of its expenses, costs, and taxes. In simple terms, revenue tells you how much money the company makes, but net income tells you how much money the company actually keeps. This is extremely important because the main goal of any business is to generate profits. That's why investors like to see net income growing over time. Growing profits are often a sign that the company is being managed effectively. If a company's revenue is increasing and its profits are increasing as well, that is usually a positive sign. That is why net income is one of the most important metrics used to evaluate a company's financial strength and overall performance. Earnings per share (EPS). Another important metric is earnings per share, or EPS. EPS shows how much profit the company generates for each share. The higher the EPS, the more profit the company is producing for its shareholders. Investors often like to see EPS growing over time, because growing EPS usually means the company's profitability is improving. And that's why EPS is one of the most widely followed metrics in fundamental analysis. And if you'd like to find a company's EPS, you can easily find it on financial websites such as investing.com under the company's financial data and key statistics. Price-to-earnings ratio. One of the most popular metrics in fundamental analysis is the P/E ratio. This metric shows how much investors are willing to pay for a company's earnings. In simple terms, it helps us determine whether a stock is expensive or relatively cheap compared to its profits. You can easily calculate the P/E ratio yourself. Simply divide the stock price by the company's earnings per share (EPS). For example, if a stock is trading at $100 and its EPS is $5, the P/E ratio would be 20. You can also find a company's P/E ratio on financial websites such as investing.com under the company's statistics and financial data. In general, a lower P/E ratio compared to competitors within the same industry may indicate that the stock is undervalued or that investors are paying less for each dollar of the company's earnings. However, the P/E ratio should always be compared with companies in the same sector, because a low P/E ratio does not always mean the stock is a better investment. Debt. Another important metric is a company's debt. High levels of debt can put pressure on a company's profits in the future. That is why investors generally prefer companies with manageable debt levels and a strong ability to meet their obligations. However, having debt does not necessarily mean a company is bad. What matters is whether the company can manage its debt effectively. So before investing, it is important to look at the company's debt and compare it to its earnings and ability to repay its obligations. Growth. The final important metric in fundamental analysis is growth. Investors like companies that continue to grow over time, whether it's growth in revenue, profits, or the number of customers, because consistent growth is often a sign that the company is expanding and improving its business. In general, companies with strong growth rates tend to have greater potential to increase their value in the future. That is why growth is one of the most important factors investors look at when evaluating a company. And with that, we've covered the most important metrics used in fundamental analysis. In the next video, we'll learn technical analysis and how investors read stock charts and price movements. If you enjoyed this video, don't forget to like, subscribe, and share it with someone who wants to learn investing.
Please subscribe and don't forget to hit that bell.